You're not bad with money. You've just been lied to about how money actually works, and those lies are quietly keeping you broke. Most people believe money decisions are made logically, as if humans sit down with perfect information, neutral emotions, and a calculator before every financial choice. In reality, money is processed emotionally first and rationally second. Long before math enters the picture, the brain has already decided what feels safe, what feels risky, and what feels rewarding. This is why intelligent, educated, and hardworking people routinely make financial decisions that look irrational from the outside. They are not failing at maths. They are acting in alignment with deeply ingrained emotional patterns formed over years of lived experience. Every person carries a unique internal story about money that was written long before their first paycheck. Childhood experiences play an outsized role in shaping this story. Growing up in a household where money was scarce often programs the brain to prioritize security above all else, leading to behaviors like hoarding cash, avoiding investments, or experiencing constant anxiety even when finances are stable. On the opposite end, growing up during times of economic expansion or in households where money flowed easily can create an exaggerated sense of optimism, encouraging risk-taking and the belief that losses will always be temporary. Neither approach is inherently logical or illogical. They are emotional survival strategies developed in response to specific environments. Because the brain is wired to protect rather than optimize, financial decisions are filtered through fear, comfort, and familiarity. When markets fall, panic selling feels like self-preservation. When assets rise rapidly, chasing them feels like safety in numbers. These reactions are not random. They are evolutionary responses designed to help humans survive threats, not build long-term wealth. The brain interprets financial loss as danger, triggering the same stress responses used for physical threats. This is why market volatility feels personal and why logical explanations often fail to calm emotional reactions. Social influence further amplifies emotional decision-making. Humans are deeply social creatures, and financial behavior is heavily shaped by what others appear to be doing. When friends, coworkers, or media narratives celebrate certain lifestyles or investment successes, the brain equates participation with belonging. Spending money becomes a way to signal competence, success, or status, even when it undermines long-term stability. Conversely, choosing restraint can feel like falling behind, even if it aligns better with personal goals. This pressure operates quietly, convincing people they are making independent choices when they are actually responding to social cues. Past experiences with success or failure also leave lasting imprints. A single bad investment can permanently increase risk aversion, while an early win can create overconfidence that persists long after circumstances change. The brain generalizes from limited data, forming broad conclusions from narrow experiences. These conclusions then guide future decisions automatically, often without conscious awareness. What feels like intuition is frequently just emotional memory masquerading as insight. The illusion of rationality makes these patterns difficult to recognize. People prefer to believe their choices are deliberate and logical, so they construct explanations after the fact to justify emotionally driven decisions. This self-narration reinforces existing behaviors, making them feel correct and inevitable. Over time, these reinforced patterns solidify into habits that shape entire financial lives. Understanding that money decisions are emotional does not mean abandoning logic or discipline. It means recognizing that behavior drives outcomes more powerfully than knowledge. Two people with identical incomes and access to the same information can end up in vastly different financial positions because their emotional responses differ. One reacts impulsively to fear and excitement, while the other remains steady under pressure. The difference is not intelligence but emotional awareness. When people grasp that money is emotional before it is mathematical, judgment fades and clarity emerges. Financial mistakes are no longer signs of stupidity or weakness, but predictable outcomes of human psychology. This awareness shifts the focus away from chasing perfect strategies and toward understanding personal triggers, fears, and motivations. Once those forces are acknowledged, Money stops being a source of confusion and becomes a reflection of behavior. The math was never the hard part. The human mind was always the real variable. One of the most powerful and least discussed forces shaping financial outcomes is the absence of a clearly defined sense of enough. Without knowing what enough looks like, people default to perpetual accumulation, believing that the next milestone will finally deliver security, satisfaction, or peace of mind. Yet history and psychology repeatedly show that this moment rarely arrives. Instead, the goalposts move, and what once felt like abundance quickly becomes the new baseline. This cycle creates a form of financial restlessness that keeps people running long after their basic needs and genuine comforts have already been met. The human brain adapts rapidly to improved circumstances. What initially feels like a breakthrough soon feels ordinary. A higher income becomes expected. A larger home becomes normal, and upgraded possessions fade into the background of daily life. This adaptation is not a character flaw, but a neurological feature designed to keep humans motivated to improve their situation. The problem arises when this mechanism operates without boundaries, without a conscious definition of enough. Adaptation turns into escalation, and escalation turns into chronic dissatisfaction. When enough is undefined, risk-taking increases in subtle but dangerous ways. People begin to gamble not out of necessity, but out of comparison and expectation. They risk financial stability to chase symbols of success, prestige, or validation that promise fulfillment but deliver only temporary satisfaction. Relationships, health, reputation, and peace of mind become collateral damage in the pursuit of more. The tragedy is that these sacrifices are often made after comfort has already been achieved, not before. The pursuit is no longer about survival or growth, but about keeping up with an ever-expanding internal benchmark. The absence of enough also distorts decision-making by blurring the difference between needs and wants. Once the threshold of comfort is crossed, additional gains do not significantly improve quality of life. Yet they carry increasing costs. More income often demands more responsibility, more stress, and more time traded away. Larger lifestyles require larger commitments, reducing flexibility and increasing dependence on continued high earnings. Without realizing it, people trade freedom for accumulation, believing they are moving forward while quietly narrowing their options. Defining enough creates a psychological anchor in a world designed to pull attention outward. It introduces a stopping point in a system that constantly encourages acceleration. This anchor does not eliminate ambition. It refines it. Instead of chasing endless growth, effort becomes focused on protecting what already exists and maximizing the quality of life rather than the quantity of possessions. This shift fundamentally changes how success is measured. Progress is no longer tied to external comparison, but to internal alignment. People who understand enough approach money differently. They are less reactive to market swings, less influenced by trends, and less tempted by shortcuts that promise rapid expansion at the expense of stability. Their decisions reflect a long-term perspective rooted in sufficiency rather than scarcity. They recognize that the greatest risk often comes not from having too little, but from never knowing when to stop. The concept of enough also exposes a common misunderstanding about motivation. Many assume that defining limits will reduce drive or dampen achievement. In reality, the opposite often occurs. Clear boundaries reduce anxiety and create focus. When people know what they are aiming for, they can allocate energy more efficiently and avoid distractions that dilute effort. Ambition becomes intentional rather than compulsive. Perhaps the most profound impact of defining enough is its effect on contentment. Financial success without satisfaction becomes a hollow victory, marked by constant comparison and persistent unease. Enough introduces a sense of completion that allows people to experience the present rather than postponing happiness indefinitely. It reframes wealth as a tool rather than a scoreboard, emphasizing stability, autonomy, and peace over endless accumulation. In a culture that equates progress with more, choosing enough is a radical act. It challenges the assumption that growth must be infinite and that worth is measured by accumulation. Those who grasp this concept stop playing a game with no finish line. They understand that wealth is not about reaching the highest possible number, but about reaching a point where money no longer controls decisions. Enough is not a limitation. It is the moment when money starts working for life instead of life working for money. The idea that wealth is built through brilliance, perfect timing, or rare insight is deeply ingrained in modern culture. Yet it is fundamentally misleading. Compounding does not reward intelligence, creativity, or boldness nearly as much as it rewards time and consistency. The most powerful force in wealth building operates quietly and slowly, favoring those who remain steady over long periods rather than those who seek dramatic wins. This reality is uncomfortable because it strips away the fantasy that success comes from a single clever decision and replaces it with a process that is repetitive, patient, and often unremarkable. Compounding works through accumulation rather than acceleration. Small actions repeated consistently create exponential outcomes, but only if they are allowed to run uninterrupted. The early stages feel insignificant, which is why many people abandon the process prematurely. Contributions seem too small to matter. Progress feels invisible, and the temptation to chase faster results grows. The human brain is poorly equipped to appreciate exponential growth, especially when the payoff lies far in the future. As a result, people undervalue consistency and overvalue intensity. Time is the most critical ingredient in compounding, yet it is also the one most often underestimated. The difference between starting early and starting late is not linear. It is dramatic. A few extra years of consistent investing can outweigh decades of larger but sporadic contributions. This is not because early starters are smarter or more disciplined by nature, but because they give compounding more opportunity to work. Once momentum builds, growth feeds on itself, creating results that appear impressive only in hindsight. Consistency matters more than contribution size because it removes decision-making from the equation. Regular behavior reduces the influence of emotion, fear, and excitement, which are the primary disruptors of long-term outcomes. Sporadic investing often reflects emotional reactions to market conditions, personal confidence, or external noise. These fluctuations interrupt the compounding process, resetting progress and diminishing returns. Steady behavior, even when imperfect, allows growth to continue uninterrupted. The cultural obsession with genius moves distorts expectations. Stories of overnight success, lucky bets, and extraordinary insight dominate attention, even though they represent rare exceptions rather than reliable paths. These narratives create the illusion that wealth is a product of talent rather than endurance. In reality, many of the largest fortunes were built through unremarkable decisions repeated for decades. The difference lies not in complexity but in persistence. Compounding also exposes the cost of impatience. Seeking faster results often leads to behaviors that undermine long-term growth, such as excessive risk-taking, frequent changes in strategy, or abandoning plans during periods of stagnation. Each interruption sacrifices future exponential gains in exchange for short-term emotional relief. The true cost of inconsistency is not just lost money but lost time, which can never be recovered or replaced. What makes compounding especially challenging is its delayed gratification. The most meaningful results occur late in the process, after years of discipline with little visible reward. This creates a psychological mismatch between effort and outcome, causing doubt and frustration. Many people quit just before compounding becomes noticeable, mistaking slow progress for failure. Those who persist are often indistinguishable from everyone else until time reveals the difference. Compounding does not require perfection. Missed contributions, market downturns, and imperfect timing do not derail the process as long as consistency is restored. What matters is remaining engaged over long periods, allowing gains to build upon gains. This resilience makes compounding forgiving to mistakes but unforgiving to abandonment. The simplicity of compounding is what makes it so powerful and so ignored. It offers no excitement, no shortcuts, and no immediate validation. It rewards patience in a culture addicted to speed. Those who understand this stop searching for extraordinary solutions and focus on ordinary actions performed reliably. Over time, these actions compound not just wealth but confidence, stability, and control. Compounding is not a test of intelligence. It is a test of temperament. And time ultimately favors those who stay. Financial plans are often built on the assumption that life will unfold in an orderly and predictable way. Spreadsheets project steady growth, stable income, and rational decision-making over long periods of time. Reality rarely cooperates. Careers are disrupted. Markets crash. Health issues arise. And personal circumstances change without warning. The flaw in most financial planning is not a lack of sophistication, but an underestimation of how frequently plans fail. The difference between those who build lasting wealth and those who struggle is not the absence of setbacks, but the ability to survive them without permanent damage. Uncertainty is not an exception in financial life. It is the norm. Unexpected expenses, job losses, economic downturns, and personal emergencies are inevitable over long timelines. Yet many people structure their finances as if stability were guaranteed. They optimize for growth during good times while leaving little margin for error. This creates systems that perform well only under ideal conditions and collapse when stressed. When plans fail, panic replaces strategy, and short-term survival decisions often undermine long-term goals. Preparation for failure changes the entire approach to money. Instead of asking how to maximize returns, the focus shifts to how to remain functional when conditions deteriorate. This mindset prioritizes resilience over efficiency. It accepts that some resources will appear idle or underutilized during calm periods. But those same resources become invaluable when disruption occurs. The purpose of preparation is not to predict specific events, but to remain flexible regardless of what happens. Emergency reserves illustrate this principle clearly. Money set aside for unforeseen events does not generate impressive returns, attract attention, or feel productive. It sits quietly, seemingly inefficient, while other assets pursue growth. Yet its value lies in what it prevents rather than what it produces. It prevents forced selling during downturns, prevents reliance on high-cost debt, and prevents desperation-driven decisions that compound stress. In moments of crisis, liquidity becomes more important than optimization. The psychological benefit of planning for failure is often underestimated. Knowing that setbacks are survivable reduces fear and reactivity. When people feel protected against worst-case scenarios, they are less likely to overreact to short-term fluctuations. This emotional stability supports better decision-making over time. Without it, even well-designed strategies unravel under pressure. Fear accelerates mistakes, while preparedness slows them down. Resilient financial structures are built with slack. This slack may take the form of lower leverage, diversified income sources, or conservative assumptions about future earnings. While these choices may reduce short-term gains, they dramatically increase durability. Systems with no margin for error rely on constant favorable conditions, which rarely persist indefinitely. Systems designed to absorb shocks can adapt and recover. Planning for failure also acknowledges the limits of control. No amount of research, forecasting, or expertise can eliminate uncertainty. Accepting this reality encourages humility and flexibility, rather than attempting to outsmart every risk. Resilient planning focuses on staying in the game long enough for time and compounding to work. Survival becomes the prerequisite for success. Those who endure financial storms often do so quietly. Their preparation is invisible during prosperous times and only reveals its value when others are forced into damaging choices. They are not immune to loss or stress, but they avoid irreversible outcomes. By remaining solvent, liquid, and adaptable, they preserve the ability to recover and continue forward. The irony of planning for failure is that it often leads to better long-term results. By avoiding catastrophic losses, resilient strategies protect the foundation upon which growth depends. Optimization seeks the highest possible outcome under perfect conditions, while resilience seeks acceptable outcomes under all conditions. Over long periods, the latter proves more effective. Financial life is not a straight line, but a series of disruptions and recoveries. Plans will break, assumptions will be wrong, and conditions will change. The goal is not to prevent failure, but to design systems that can endure it. Those who understand this stop chasing fragile perfection and start building structures that bend without breaking. In a world defined by uncertainty, Durability is the true advantage. True financial intelligence rarely announces itself. From the outside, it appears unremarkable, repetitive, and even dull. This is because effective money management does not rely on dramatic action or constant movement. It relies on restraint, patience, and the ability to remain calm when others are driven by emotion. While flashy success stories dominate attention, the behavior that actually builds wealth unfolds quietly, often unnoticed, over long periods of time. Periods of market excitement and fear create powerful psychological pressure. When prices rise rapidly and optimism spreads, the urge to participate intensifies. When prices fall and pessimism dominates, the instinct to retreat feels overwhelming. These collective emotional swings tempt people into action at precisely the wrong moments. Acting feels productive, while inaction feels negligent. Yet in finance, unnecessary action is frequently the enemy of good outcomes. The discipline to do nothing when doing something feels urgent is one of the hardest skills to develop. Boring financial behavior often means sticking to a predetermined course regardless of noise. It means continuing to invest during downturns when confidence is low and refraining from excess during booms when enthusiasm is high. This consistency looks passive, but it requires active emotional control. Resisting panic during losses and resisting greed during gains both demand going against deeply ingrained instincts. Human evolution favored rapid responses to perceived threats and opportunities, not slow, deliberate patience over decades. What separates successful long-term investors from the rest is not superior information, but superior temperament. Most people have access to the same data, yet they interpret and act on it differently under stress. Emotional reactions override rational plans, leading to buying high, selling low, and abandoning strategies at the worst possible time. Those who appear boring are often the ones who simply follow through on decisions made when emotions were calm. The simplicity of effective financial behavior makes it easy to underestimate. There are no clever maneuvers, constant adjustments, or impressive explanations. It involves repeating the same actions year after year, even when they feel unsatisfying or slow. This repetition builds resilience and momentum, allowing compounding to work uninterrupted. Complexity, by contrast, often introduces friction, fees, and emotional engagement that undermine long-term results. Boring financial strategies also reduce exposure to behavioral mistakes. By minimizing decisions, they reduce opportunities for error. A straightforward approach limits the need for constant evaluation, prediction, and reaction. This creates psychological distance from short-term fluctuations, making it easier to stay focused on long-term goals. The fewer decisions required, the less room there is for emotion to interfere. From the outside, this restraint is rarely admired. Society celebrates visible action, bold moves, and rapid success. Quiet consistency does not generate headlines or admiration. There are no dramatic turning points or heroic moments. Progress occurs slowly, almost invisibly, until time reveals the cumulative effect. By then, the result appears inevitable, even though it was anything but guaranteed. Boring financial behavior also aligns with sustainability. It does not demand constant vigilance or emotional investment, because it is manageable and repeatable. It can be maintained over long periods without burnout. This endurance is critical, as wealth accumulation is a long-term process that rewards those who remain engaged without exhausting themselves. The paradox is that what feels dull on a daily basis often produces extraordinary results over decades. Stability compounds quietly, while volatility amplifies mistakes. Those who understand this learn to measure success not by excitement or novelty, but by consistency and endurance. They accept that progress will be slow and uneven, and that comfort with boredom is a competitive advantage. In the end, financial genius is not about being right more often than others. It is about being wrong less catastrophically. It is about avoiding behaviors that cause irreversible damage and allowing time to do the heavy lifting. The people who master this rarely look impressive in the moment. They look average, cautious, and unremarkable. But over time, boring behavior proves to be the most powerful strategy of all.